Monday, April 10th. We have a bank holiday through Europe, but Wall Street is open, and let's kick things off this morning. So hope all is well. We begin with a risk disclaimer. We understand it's risk in trading. Please don't always use trade capital only. Do not trade with money you can't afford to lose. Whether you're trading stocks, options, futures, forex, cryptos, you know the deal. If you're following me on social media, make sure it's the real me. YouTube.com/Chris Pulver. Best place to find me. Everything else handles are consistent. Try to keep them the same. Facebook.com/Real Chris Pulver. Instagram, Twitter @Real Chris Pulver. All right, let's go into the charts. I have the economic calendar up. Like I said, we have bank holidays in Europe. It's Easter Monday. Hope all of you had a great weekend. Enjoyed the Masters, all that good stuff. We get into the meat of the week on Wednesday. US CPI data coming out. We're looking at a pretty big jump to the downside. So 6% was the previous print year over year. Now we're looking at 5.2. Again, if inflation direction continues to go the right way, which is down, we're probably going to see that in a way the Fed has done what they needed to do. So we take a look at the Fed Watch tool. I'll get logged in here to YouTube in just a moment. But we know the Fed just raised rates in March. There's no rate decision official until May 3rd. So we're looking at this is another 25 basis points rate hike coming in March, or I'm sorry, in May. So if we have one in May, then we're looking for that pause to kick in. So May, June, July, September, likely a pause. We can take a look and go further out to the CME Watch tool and see where we're at. But this is jumped around and changed quite a bit. Again, it's subject to change coming out with the CPI data this week. If it comes in, especially if it comes in 5.2 as expected, that's a big jump to the downside. So that's 0.8%, and we have not seen a jump like that in a while. I think the biggest improvement we've seen in inflation is 0.5%. If I look back at our intervals here, we had, I'm looking at the high point, around 9.1. See if I can, it's not letting me. I was trying to look at the actual data point. So we're at 6.0 right now year over year. We had a 6.4, 6.5, 8.2, and our biggest drop off was here. We had the 8.2 give or take all the way down to 6.5. That was a big drop and I'm trying to think, is there one in between there? This looks like maybe this is steady. I'm trying to get the intervals. Let me go to, let's do this. There we go. So here's your monthly interval. So I knew we had some more data in there. So peak around 9.1, and then steadily, and this is the interval I was talking about. So we have around 8.2, drops to around 7.6. So we've had 0.5% improvements since the high of June of 2022. This is a pretty big drop from 7.7 down to 7.1, 7.1 down to 6.5. So, 0.5, 0.6% improvement. And now from 6% down to 5.2, that would again be another pretty big drop to the downside, where we essentially have deflationary pressures kicking in right now. And how the market reacts and how the market takes it remains to be seen, but we will of course follow along. So let me go into candlesticks here. There we go. Let's go into the daily. We're trading right now at 406. So pre-market, actually it's opening bell. Pre-market was down a little bit by a couple of dollars. We had a slight gap to the downside, and pressure's on. So I do have some Monday expirations today. I've got a 415 on the SPY, and I believe I have a 320. Yeah, 322 on the Qs. So unless we get a big old rip to the upside today, we'd have to see the Qs rip 2.6% to the upside. Otherwise, those bear call spreads will be nice for some income right there. So I'll be watching that today for Monday expiration at 4 p.m. Expiration-wise, we're going out to the 14th this week. Let me bring up my notes. Let me get logged into YouTube and say hi to everybody. Give me a moment. And lots of classes today. Give me a second. Hello, everybody. All right. Charles is in the house. Good morning. Gary, good morning. Ruthann, good morning. Willard, good morning. Chris, good morning. Katrina, good morning. Donna, Andrew, David, Jason. Nice to see everybody. FK, good morning. Matt, good morning. All right. Benji, good morning. That's my dog. Okay, so I was just going to take a look at some of the expirations for this week. 414. Only a couple, but I do have a lot for the 421 expiration. So 414, I do have some expirations running for today. Like I said, the Qs and the SPY, that's a 322 by 326. 415. I think that's supposed to be a 315. Is it? No, that's right. That's right. 415 by 419. Yep, that's fine. Okay, so there's some income. Let's go out to 414. Coinbase bull put spread for this Friday. So Coinbase bull put spread, DIA 315. That should be fine for some profit this week as well. 315 by 310 on the DIA. Let me check this one really quickly. The DIA trading at 333. Yeah, we're 20 points above that. That should be fine for profit this week as well. And Microsoft bull put spread 250 by 245. Microsoft trading at 287. So 250 by 245 should be totally safe for some income this week. Okay, very good. Scott, good morning. Don, good morning. Any requests, any charts you'd like to take a look at? So I'll be doing some option management today for the SPYs, the Qs, watching the 414 expirations. Currency-wise, currency strength chart. Let's go to Friday of last week. Things are pretty contained. It was Good Friday, so Wall Street was closed. We had a ton of choppy volatility in here. We also had non-farm payroll. You can see right there. That's from Friday last week. I didn't actually look and see, so I was fortunate to go to the Masters last week, and Good Friday was nice that Wall Street was closed. I didn't really have a lot to worry about, but we did have a job report, so let me see what that was last week. So if we go to Friday, expected 228 came in 236. Revision up from 311 to 326. Unemployment rate was improved by 1/10% to 3.5. Average hourly came in as expected. Okay, so pretty steady job print. I'm guessing in hospitality and service mostly. That's where we're getting a lot of them. Monthly T-bills, okay. Take a look at those. U.S. 1 month trading at 4.45. So let's take a note here. Let me type this in. So we'll do a U.S. 1 month at 4.45. We'll do a 3 month. We'll do a let's see. 3 month is good. I like the 1 year. U.S. 2 year. U.S. 10 year. All right, so that captures a lot of our short-term oscillations, and then the 2 and the 10 is the big inverted yield curve that everyone pays attention to. A lot of what I also watch as far as correlations with recessions and inverted yield curve is the 3 month and the 10 year. That's also a good one too. So let's take a look at all those. So we have the 1 month at 4.45, the U.S. 3 month at 4.84. So 4.84 right here. Okay, U.S. 1 year trading at 4.67. 4.67. The 2 year trading at 3.98. So just shy of 4%. And the 10 year trading at 3.39, just shy of 3.4. 3.39. Okay, so that is a rundown. Yeah, I was a fair weather spectator. When the trees fell on 17 on Friday, I was not there. I was aware enough of the weather to be like, well, I was there all day Wednesday, all day Thursday, all morning to afternoon Friday from like 8 to 2. That's when the weather started to get pretty bad. So I left on Friday. Saturday was just a spectator at home because the weather was awful, and ended up flying back out to Salt Lake City Saturday night. So I watched the Masters from home yesterday, which was great. I mean, yesterday was awesome, but Saturday was brutal. Tough conditions for all the players to just have to grind out uh, part of a round, suspended play on Friday afternoon and on Saturday. It was just tough tournament. So I expected some more excitement and drama on Sunday. Didn't really get it. We had some good runs by Spieth and Mickelson, but yeah, Brooks just kind of drifted lower, and Rahm just played solid and steady. So I mean, both those guys should be shooting 68, 69 just based on the par fives, and Rahm did and Koepka didn't. So anyway, but all in all, awesome experience, and super happy I was there, and I'm going to try to make that an annual thing. It was a blast. So good stuff. Okay, so inverted yield curve, real quick. We have one. We've had one for a while. So the 2-year and the 10-year still inverted by 0.5%. The 3-month and the 10-year also, inverted by quite a bit, 1.5, so 150 basis points. It's interesting to see the game with short-term notes right now, and I just saw this interesting statistic that the bond market and the stock market is as highly correlated right now as it was back in 1996 and 1997. So really quickly, if we go to the SPX, I just want to take a look. Let's go to the weekly. Let's go back to 96, 97, and just get a feel for where. And keep in mind, I mean, we had a pretty good decade from the 90s into the late 90s, and then we had our dot-com burst in 2000. But if we go back into the 90s, and we had some high correlations with bonds and stocks, we're looking at a steady little run, right? So here's our. I mean, and part of me thinks that this is when we would have had it. I can verify this, but this drop here, 98, we had a pretty nice correction. And when we see a tightening in correlation with stocks and bonds, this is where the market causes a low. We had a nice little run to the upside from 98 to 99. I wouldn't be surprised, and part of me is still not 100% convinced that we're going to have a bull market this year. But I think the reason we could have a bull market, it might seem, unfitting or irrational to some, but it's because nobody is participating. I think people are clearly, fearful of the bank situation. People are, a little bit sketchy and gun shy in the stock market right now, and that's kind of exactly when it's an opportunity to see a rally, because there's not a lot of participants, there's not a lot of active shorts, and what you have instead is you have active buyers, right? I mean, if you think about this, I'll just throw this number out there. Um, well, throw the magic number 401k. 401, right? The 401ks. Think about how many trillions and trillions of dollars are tied up in targeted funds that are forced to make purchases every month with dollar cost averaging. Whether they're buying mutual funds, whether they're buying stocks, there are forced buyers in these markets every month. Okay. That being said, if there's not a lot of participation to aggressively sell the market, look, we've had a rate hike cycle. We're seeing the top of the rate hike cycle by the Fed. Whether they raise rates by 25 basis points in May, the market's anticipating that. We don't expect to see more rate hikes. This is a pause for June. This is a pause, possibly a cut coming in July. Same thing, pause or cut in September. But by December, this is really the big part, is where we're going to be. And the question here is, we can raise rates, we can pause, we can deal with a recession, and then the Fed starts cutting rates, as we possibly define and realize and admit that we're in a recession. Whether that recession is a soft landing, softish landing, I think it's certainly better than what we were expecting from last year. So still the potential, anomaly this year, black swan this year, could be the debt ceiling, right? We could have a huge debt ceiling problem in the U.S. Because without it, it's going to cause a lot of problems, not just politically but also fiscally. So that might be the one thing that if the U.S. gets through it, doesn't drag it on and makes some 11th hour decision, that perhaps it's a little bit more smooth sailing for a soft landing. But like I said, I just wanted to see what the correlation was back into the 90s, because that correlation came with a correction, which we certainly had. And percentage wise, I mean, that is a 21% correction. Well, in 2022, we had a peak to trough of around 28% on the S&P. That peak to trough there is around 23%. So similar, And if we see, heavy correlations with stocks, equities and bonds, the bond market to me looks pretty promising to the upside. If we go to the TLT, that's the 20-year. Let me go back to the daily chart here. Yeah, here we go. So this looks like a really solid cup and handle pattern right here. So we had this big dramatic drop. We're consolidating in here. Now we could range, but if we break above, that's a good move in the bond market. If we see the bond market going up, and let's see what that percentage is. Let's say we break this neckline around 110. Okay, we break above 110, and that could be a 10 to 11% move right there just to measure symmetry. Um, I'm not saying that has to be 1-to-1, but I could see a similar rally in the stock market, right? We could rally up 10 to 12%. Does that get us back to highs from 2022 or 2021? No, nowhere close to them. But we'd be at least making a directional play because right now we don't have a directional play. In order for the market at current prices to get all the way back to the highs, we have to see a 15 to, let's see what that number is, 17% rally. So we could get there. Again, I'm just watching the major levels. If we start, breaking highs, do we have break the highs, then we break back down, make a higher low? We do have a lot of volatility. But again, this is just kind of the bigger picture stuff that I'm watching. I think that everyone is calling for bear markets. I think everyone's prepared for bear markets. But at the same time, there's not really, active shorts. If there were active shorts and heavy positioning, then I would be paying more attention to that, but there's really not. So I think that this could be a year of not a lot of participation, movement into more fixed income, bank CDs and short-term gains to be safe and liquid, and also a melt up. I think the melt up is possibly the theme this year. So that's what I'm looking to navigate. So anyway, all good. So we'll be watching. Let's check some currencies. Let's go DXY, oil, gold, silver, some Bitcoin. Dollar index coming in off the lows. So we still didn't break the lows yet at 100.81. Still haven't broken the highs. So I just have chart alarm set on the dollar. We break in the highs, we break in the lows. Is this a bullish pattern that's just a very deep pullback? Is this our, left tip, center tip, right tip that's very deep on the dollar that ends up coming back up? Or is this more indecision? We might have a lower high and a higher low. We have some type of wedge out here that's going to drag on longer. I'm not really sure. I still like the inefficiencies up here on the dollar, so I'm watching that. Okay, so that's the DXY, but off the low so far. Looking at the currency strength for today, the dollar is creeping up to the top. So we have dollar CAD on top today. JPY is softer. This is the New Zealand and the Swiss as well. So we'll see how that plays out going into this week, if that's sustained or if it's just a short-term move as we get into Tuesday, Wednesday, Thursday. But DXY is up for the day. Oil, we had announcements that Saudi Arabia and OPEC members are going to be cutting by 1 million plus barrels a day. That forced a big gap here in oil. Certainly that gap can get filled. But what I do like about this is sitting right here at this pause. If we break above this 200 EMA, there's room for oil to continue to rally up towards 95. Now, I still think that from $65 to $95, there's a range where oil can exist and not really be a problem. I'm sure there's going to be some headlines that like, oh, oil's up off the lows blank percent from 65 to 95. I mean, that's a 40+% move off the lows. Now, if the only real catalyst for that is cutting production by a million barrels, I mean, that's really not a lot in the grand scheme, but it's enough to make the market move, right? And there's a big difference between U.S. cutting production and the other contributors to the world oil cutting production, like OPEC and like OPEC plus members. So anyway, big movement, right? That was big news last week, and we didn't really see much follow through. But I've got some positions on USO. I've been looking to buy oil off those lows, and USO we had some nice gaps. I think I have some credit spreads running on USO 66 by 65s. We're trading at 70. I've got 70 by 65s. We'll take a look at some of those levels and expirations. Those are out further, but we're looking for oil to rally going into summer. Gold and silver had a pretty good run. We turned recently off of the 2034 high. I still think that we could stay higher, still squeeze, still drift up here. This could be a really big theme for the year. Okay. I know that this looks like resistance right here at 2075. I'm certainly seeing that on my charts. But the reality is, if this 2075 level does not hold as resistance and we break above this, I think gold has a long ways to go. If gold goes up, expect the dollar, okay, to go down. So this could be a big play this year. This could also be finally the big inflation hedge where gold, that's usually what it gets credit for. A combination of, it's a store of value. It's always been seen as an inflation hedge. It's a fleet of safety sometimes. So there could be a lot of reasons why gold continues to run. We have about a 2-year range here that goes back to the high in 2020. I'm just saying. I mean, this could line up perfectly for this like beautiful rising wedge, and it looks like we would break down. But if we do not, we break above here, there's a lot of movement to the upside because you could have this bigger move that goes up. You could have a pullback, and then you project this move higher. We could be talking about 2,500 on gold. Okay. So I will be watching this 2070 level very carefully because if it breaks and goes higher, I will be bullish on gold even on a breakout. If it rejects and proves that it wants to go back down, then we can range trade gold. But I think this will be a good trade this year. Silver's been on a nice little rally as well. Silver's trading up at 24.80. We have recent highs all the way back up towards 27 and 30. I'm looking for dips. If we get pullbacks and dips or pauses, I'm looking to buy more silver. So I like silver all the way up towards $29 to $30. I put in a covered call on the shares that I have for SLV. We're trading right now at 22.80. I think I covered it at 24.25 out to May. I put a chart alarm there at 24. Yeah, I covered it at 24 out to May. So I lowered my cost basis on my shares by like 50 cents. Went out a month or so. And if I get it called away at 24, that's not bad. My break even is like 17 and change. So I'll certainly take that. And any dips, we'll start looking at some credit spreads. We could talk, 23 by 22s this week. We could go a little bit more in the money and just look on being bullish over the next, I don't know, the next 6 months or so on silver and just stay bullish with this. Again, this is another one that there's room to get up to the highs around 26 to 27. This is SLV, and that'd be the equivalent to about $30 on silver on XAG USD. So if we have any dips and pullbacks, I'd like to add some credit spreads. We can add some credit spreads now and just plan on being bullish and stagger that out through the rest of the year. Okay. All right. That's that. Bitcoin. Bitcoin hanging in there at 28,213. Big resistance around 30 or 30,000. So past level around May of 2021. Past level around May of 2022. It can obviously be resistance, and I could see that happening. So resistance there, right? If we hit resistance, it makes sense. We could struggle here, hit resistance at 30K, pull back down into this breakout point, find a pivot, find some efficiencies. We could have a higher low. So we have lows here, lows here. We could pull back for a higher low as well. Similar to that top in gold at 2075. If we break above 30K, we break above 30K on Bitcoin, there's a lot of potential upside there. Again, maybe not a lot of participation, maybe more buy and hold. But I'm sure you're going to see, if it breaks above 30, I think we can quickly cover this run towards, 48. That's going to feel terrible if you're not participating in some way, shape, or form. So that is why I, put in some positions here at 20K. That is why I was leveled in at 20 and 17.5 and 15. Those are the big levels that I'm watching. But now that we're up here at 28, break above 30. Going from 30 to 48, it's going to feel like you missed it, and there's still positions. I mean, we could have a run to 48. We could still have a pullback, and we could go up and create a bull market, create some wave cycles. But of course, everyone's going to be eyeing the highs around 68,000, and I think all eyes are going to be really interested at 100K. If we have a big run. So again, could happen, could not happen. Maybe we just range from 30K down to 20K, and there's a lot more indecision because there's more regulation that's needed, right? Maybe we're not even close to having a breakout yet, but given the potential, bank drama, which it's not done. I mean, we're probably going to still have more banks that are failing or needing some liquidity spots for the next 12 months or so, but we'll see. Things are always interesting, right? Okay, let's get into some currencies. I got a few more minutes. Let's go dollar, Aussie CAD. I'll just take a quick glance through these alphabetically. Aussie CAD, I'm still long. We positioned for this in the flex trading room, still looking to scale in. Aussie Swiss, I'm waiting for a trend line to break, but looking to get long. I mean, we have oversold conditions and divergence, which I'm happy to see. I'm looking to buy this, especially on the right-hand side of the trend line. If we carve out some lows, take out the high, get on the right-hand side of the trend line, I'm looking for Aussie Swiss to rally. So need that confirmation. Aussie yen crosses in general to stay short term. Aussie New Zealand, we had a recent breakdown. I haven't positioned for it yet. I'm just waiting. Aussie dollar still choppy. We might have. I think that this high and low is going to be safe. I think this low, this high, we might have the market, push down a little bit lower. We still have a pivot. We could be range bound. Maybe where price, oscillates in here longer. Okay, but I don't think we're going to take out the low or the high. I think we're just going to stall for a while. CAD Swiss, I'm looking to see if we break back above 68 plus, then get back above 69. I'm bullish on this one, looking for a trend line break over here as well. Trend line break over here. Hopefully CAD Swiss runs up to that pocket window. Yen crosses, like I said, short term. Euro Aussie, we're at 63.69. We just continue to drift a little bit higher. I said there's room. This is following my trading room. There's room up towards 60. I mean, there's room to 67 to 6,800 if we just stay with this recent breakout. So higher highs and higher lows for right now in the Euro Aussie. Euro CAD, if we break back down, there's a pivot. I'm looking for a bearish pattern actually. So I'm long on CAD Swiss. I'm looking to get bearish on Euro CAD to follow the same relationship. So if we can hit 5,000, I'm looking for some type of bearish pattern to take it back down to these lows or this pivot around 1.40. So until I have a bearish pattern, I'm not really doing much other than a pending sell at 1.50. Euro Swiss, I'm holding long. Euro Pound, no trade. Euro Yen, no trade. Euro New Zealand, we were long in this one and looking to get up to the highs around 75, and we're nearly there. We're at 74.86. So this is a good spot to be protecting profit on the Euro New Zealand just in case it turns. But a couple levels. We break this high, there's room to keep going. We turn and get confirmation that we can sell it. But right now it's, take profit if you're long. We've been long since this little breakout over here. And there's room, there's about 300 to 400 pips to the upside that we protected. So we'll see. If it breaks higher, there's room to run. Look left. We've got a yearly pivot all the way up here at 78. So there's still a few more 100 pips to the upside if we break higher. Euro dollar 108 being choppy. Highs at 110.30, lows at 105.50. Still indecisive. Pound pairs. Pound Aussie has room to run. Pound CAD sitting at equal highs has room to run if it breaks these highs. Right? If it breaks the highs, has room to run. If it breaks down, then sure, I get it. It has room to break down. But I'm looking to follow alignments, look for some trending seasons through April, May. Pound Swiss, if we can break above the 200 EMA, that'd be good. Pound Yen, no trade. Pound New Zealand, looking to stay bullish on this one towards 2.00. We're nearly there. Pound US dollar, fake out at 24.50. So keep an eye on that one. New Zealand CAD, I'm still buying. This is just a big swing. We could fill some levels in here and then still break. So I'm looking for a corrective channel on the New Zealand CAD, but I'm still buying it. New Zealand Swiss, I'm staying long. New Zealand dollar, neutral right now. Dollar CAD has come down a decent amount. I didn't get the sell trade that I wanted. I wanted to sell it up here, didn't happen. I want to buy it down here, hasn't happened yet. So no trade on the dollar CAD unless it comes to a good spot for me. Dollar Swiss, we're at 91. I'm going to see if we can end up forming a bullish pattern here. If we do, I'm targeting that area, 97 to 98 for profit. But I'm looking for a bottom and a bullish pattern to form. Dollar Yen. Dollar Yen could be this. So I think it's a crown pattern, which would be bearish. But in order to form that, we might do this. We might have a slightly, low to high, higher low to higher high. Find this, 140 to 142. This could also be a Gartley pattern where it's X, A, B, C, D. If we form a Gartley pattern there, that's a good spot to one, have some bullish profits starting now, and two, look to start selling for a bigger trade to the downside. So this one will take some time, but if it comes into those areas, 140 or 142 looking to sell, but currently I'd be looking to be buying dollar yen. Okay, copper. Sure, we'll take a quick look at copper, then I got to run. We got class at 10 o'clock. Copper futures, pretty flat right now. Still pretty well supported overall. Looking a little tentative, but pretty well supported around 3.75. And I'm looking for, copper to still run. It was a little bit easier to trade when it was all inflation related. Now it's just an instrument. I think there's way less of the materials, commodities. I don't think there's this big commodity boom. I think there's more of things are still coming down. We have CPI data this week, which is going to be important one to watch. This is on Wednesday, right? So US CPI data, that's a big one, and the market could be set up for a lot of disappointment if we don't print 5.2. As example, we print 5.5. Okay, I mean that's an improvement from 6%, but it's slower than forecasted. So I'm curious how the market reacts to that on Wednesday. So we have monthly core as well as yearly CPI. We also have a Bank of Canada rate decision, which is expected to pause at 4.5. We have employment for the Aussie as well. And what else? PPI for the US on Thursday and core retail sales on Friday. So it's really a dollar news week. We have FOMC minutes. We have US 10-year bond auction. We have G20 meetings going on this week, but Bank of Canada rate decision. But CPI is going to be the big one. And like I said, I mean, a 0.8% improvement is a big chunk. That would show that those deflationary pressures are at work and doing their thing. But I'm very curious how the market, prices this in on Wednesday, Thursday, Friday for the rest of the week. Okay. All right. I'll wrap it up. I'm going to jump over to Equities on Demand. Nice to be with everybody today. Nice to be back. And we'll be business as usual this week. A lot of classes today. I'm doing a makeup class for Master Flex this afternoon. I'm doing a makeup class for my Equalizer Pro this afternoon. And I'll be in a bunch of webinars. So be a busy day, busy week. And I'm looking forward to seeing everybody in trading, Flex Trading Room, Equities on Demand, and just being back at it. Okay. Thanks. Talk to you soon. Bye.